A company does not compete with the stock market. It competes with other businesses. This is a fundamental truth that many retail investors overlook. When you buy a stock, you aren't just betting on a ticker symbol. You are betting on a living, breathing entity that must outmaneuver rivals every single day. In the world of professional investing, the chart is merely the scoreboard. The real game is played in the marketplace. Every day, companies fight for customers, for market share, for the loyalty of the consumer. They fight for talent, for the most brilliant minds in the industry. They fight for innovation, racing to be the first to solve a problem that the world doesn't even know it has yet. And ultimately, they fight for profits, the lifeblood of any enterprise. Many investors spend hundreds of hours analyzing a single company's financial statements. They dissect the balance sheet and the income statement. But professionals ask a different, more critical question. Compared to whom? Because a great company in a weak industry can struggle just to stay afloat. The external pressures of a dying market can drag down even the most efficient management team. Conversely, an average company inside an outstanding industry may still perform exceptionally well. Today, you will learn one of the most valuable skills used by institutional investors and hedge fund analysts. We are moving beyond the surface level to master competitive analysis. This is the process of identifying which businesses are most likely to dominate over the next decade. This is how you find the champions of tomorrow. Let's begin. Part 1. Why competition matters. In a capitalist system, competition is the default state. Every business faces it, regardless of their size or sector. Sometimes competition is obvious. You see the fast food chains on every corner or the tech giants battling for cloud dominance. These are the front page wars we all recognize. But sometimes competition is hidden. It lurks in the supply chain, in patent filings, and in shifting consumer preferences that happen slowly over time. If you don't see it, it's often more dangerous. Imagine opening a restaurant. You might think your competition is the bistro across the street, but in reality, you are competing for much more than just a customer's appetite. You are competing for people's time. You are competing for their attention in an age of home entertainment. You are competing for convenience against delivery apps that bring the world to their doorstep. The same principle applies to every business, from software to steel. Competition is the invisible hand that determines pricing power. If a customer has 10 identical choices, no one has pricing power. It determines profit margins. It dictates growth rates and ultimately long-term survival. Without a way to differentiate, a business is merely a commodity, and commodities eventually see their margins collapse. Professional investors never evaluate a company in isolation. They evaluate it against its competitors to see who holds the high ground. Only then can you judge a company's true worth. Part 2. Understanding market share. One of the first questions a professional analyst asks is, how much of the market does this company control? This is the starting point for any deep dive. This is what we call market share. It is a measurement of a company's sales relative to the total industry revenue. A company with a growing market share is often a sign of a superior product or strategy. It suggests that they are taking customers away from rivals. It shows they are strengthening their competitive position in real time. This is often a precursor to significant stock price appreciation. Conversely, a company losing market share may be facing fundamental challenges. Perhaps their technology is outdated, or their brand has lost its resonance. In investing, standing still is the same as falling behind. But remember, large market share alone is not enough. Being the biggest doesn't mean you are the best or the safest. In fact, being the leader often makes you the primary target for every disruptor. The truly important question is, can the company defend its position? Does it have a moat? History is filled with businesses that once dominated their entire industries, only to vanish within a decade. Think of the giants of the past, companies that seemed untouchable until they weren't. Competitive advantage is not a static achievement. It is a dynamic position that must be maintained with relentless discipline. Part 3. Using Porter's 5 forces. To move beyond simple observations, professionals use structured frameworks. The most respected of these was developed by Harvard professor Michael Porter. It is called Porter's 5 forces. It is the gold standard for evaluating industry attractiveness and the intensity of competition. Professionals use it to determine if a market is worth entering or investing in. The first force is competitive rivalry. How intense is the fight among existing competitors? If a market is saturated with aggressive rivals, price wars become inevitable. In highly rivalrous industries, companies spend millions on advertising just to hold their ground. This erodes profits. You want to find industries where the rivalry is rational and the players are disciplined. The second force is the threat of new entrants. How easy is it for a new company to enter the market and steal share? If barriers to entry are low, your margins are never safe. Great businesses often have high barriers, whether it's massive capital requirements, complex regulations, or proprietary technology. The harder it is to join the club, the more valuable your membership. The third force is supplier power. Can your suppliers force you to pay higher prices? If you rely on a single source for a critical component, they own your margins. Successful companies diversify their supply chains or gain enough scale to dictate terms to their vendors. When you control the input costs, you control your destiny. The fourth force is customer power. Can your customers easily switch to a competitor? If your product is a commodity with no brand loyalty, the customer has all the power. But if you've built an ecosystem or a brand that customers can't live without, the power shifts back to you. High switching costs are an investor's best friend. The fifth and final force is the threat of substitutes. This is the most dangerous force because it often comes from outside your industry. It's not a better car, it's a better way to commute. Substitutes can make an entire industry obsolete overnight. Professionals watch for these shifts relentlessly. The stronger these five forces are, the harder it is to maintain high profits over the long term. Now we move from the framework to the micro-analysis. How do we pick the specific winner? In every industry, there is usually one company that sets the pace. They aren't always the oldest or even the largest by headcount, but they are the most dominant in terms of economic performance. Professional investors spend their careers looking for these leaders. We identify them by comparing multiple factors. We start with the hard numbers, revenue growth. Is the company growing faster than the industry average? We look at profit margins. Are they consistently higher than the competition? High margins are the first sign of a sustainable competitive advantage. Then we look at return on capital. This is the ultimate test of management. How much profit is the business generating for every dollar invested? A company that can consistently generate high returns on capital is almost always an industry leader. We also examine cash flow, debt levels, and the strength of the balance sheet. But the numbers only tell half the story. Professionals also look at qualitative factors: brand strength, management quality, and the economic moat. Rarely does one company lead in every single category. The goal is to understand relative strength. Who is improving? Who is falling behind? Part 5. Pricing power. One of the greatest competitive advantages a business can possess is pricing power. Warren Buffett once said that the single most important decision in evaluating a business is pricing power. If you have the power to raise prices without losing business to a competitor, you have a very good business. Businesses with pricing power enjoy stronger profit margins and more predictable cash flow. They are far more resilient during periods of high inflation. When their input costs go up, they simply pass those costs on to the consumer, and the consumer pays it. This is a hallmark of a dominant brand. Ask yourself, why do customers continue paying higher prices for certain brands? Is it the perceived quality? Is it the convenience? Or is it the deep-seated trust that has been built over decades? Pricing power is the physical manifestation of a company's competitive strength. It is the ultimate moat. Part 6. Innovation as a competitive advantage. Markets are not static. They evolve constantly. In a world of rapid technological change, companies that stop innovating often lose their advantage overnight. Professional investors study R&D spending not as an expense, but as an investment in future dominance. We look at new product launches, the number of patents filed, and the rate of customer adoption. But remember, innovation is not just about creating something new or flashy. It is about creating something that customers actually value. It is about solving problems in a way that no one else can. The businesses that continue solving important problems for their customers often remain competitive for decades. They aren't just reacting to the market, they are shaping it. When you find a company that can innovate at scale, you have found a potential long-term compounder for your portfolio. Part 7. Competitive red flags. As much as we look for signs of strength, we must also be vigilant for signs of weakness. Professionals look for warning signs that a company's competitive position is deteriorating. The most obvious sign is declining market share over several consecutive quarters. Other flags include shrinking profit margins, weak customer satisfaction scores, and a slowdown in meaningful innovation. We also watch the balance sheet. Increasing debt used to mask poor operational performance is a major red flag. When management starts blaming external factors for every miss, pay close attention. One warning sign might be a temporary blip, but several together deserve your full attention. Remember, businesses rarely fail overnight. Weakness often appears gradually, like a slow leak in a ship. The goal is to spot the leak before the ship starts to sink. Protect your capital at all costs. Part 8. Building a competitive scorecard. To remove emotion from the process, professionals create structured scorecards. This allows us to compare companies objectively across a set of predefined categories. We look at business quality, revenue growth, profitability, and cash flow. We grade them on management, innovation, and the strength of their competitive advantage. We also consider valuation and risk. A structured comparison reduces emotional bias and forces you to base your decisions on evidence, not popularity. This is how you stay disciplined when the market is euphoric. Part 9. The professional mindset. Professional investors do not ask, "Is this a good company?" That is an amateur question. Instead, they ask, "Is this the best company in its industry?" That single shift in perspective changes everything about how you evaluate an investment opportunity. Investing is often about choosing relative winners, not absolute perfection. The strongest businesses consistently outperform their weaker competitors over long periods, often by a staggering margin. Finding those businesses and holding them with conviction is one of the greatest skills you can develop. The big lesson of today's session is this: every company has competitors, and every industry is in a constant state of flux. The businesses that survive and thrive are rarely the biggest ones today. They are the most adaptable, the most disciplined, and the most innovative. Identify them early. Your homework for this lesson: choose one industry you understand. Select 3 competing companies within it. Compare their revenue growth, margins, cash flow, and management quality. Then answer, if you could own only one for the next decade, which would it be and why? Research is the work. Profit is the reward. Today you learned how professional investors compare businesses, not just by stock price, but by competitive strength. Next lesson, we study capital allocation, the skill that separates exceptional CEOs from average ones. Subscribe to Wealth Entertainment 21 to never miss a lesson. The best investment is rarely just a good company. It's often the strongest company in the right industry at the right price. I'll see you in lesson 5. Class dismissed.